That's what it's going to be, the breaks, because it's whatever, it's what everybody says. But I'm going to do a
Yeah.
disclaimer every time. I'm going to say, look, if you have the balls to get out of this stuff, then go to other forms of social media. It's, to me,
They're not popular yet. Once they become popular, then other people will switch.
but they're not going to become popular until everybody jumps ship. They're not going to
That's
become
true.
popular until everybody jumps ship. So my point is, we can never count on other people to do it. We have to be
We have to be the movement,
the trend of, yeah, the
the
trend starters,
trendsetters.
exact trendsetters. That's the word. Let me see if I can change the.
Yes.
If you are on Instagram, please tell me that you can hear it, because I'm going to try to do this speaker thing closer here, whatever. Anyways, that I am trying, people. I don't like Instagram. As everybody knows, I don't like it, but that's what we're gonna do. Please let me know. Hi. Okay. I'm glad you're here. Okay, so today's class, we're doing it on Zoom. So I'm gonna be sharing my screen on Zoom. It'll be easier for you to see it. If you wanna be on Zoom, the link is below the post, so you get to see the screen shares that I'm gonna do for the topic today, and it's gonna be a bunch. And then of course, we always upload the video on YouTube, so it's on the podcast channel. But thank you, Anne, for being here, and thank you guys for, if you are on Instagram or if you are on Rumble, I'm podcasting on Rumble as well. And also, and I'll put it up on YouTube later. I'm gonna have to have another device for YouTube, but whatever. Anyways, so the topic for today, and thank you for being here. The topic for today is deciding what to do with debt. And so debt elimination, debt consolidation, just live with that, live with what you have right now going on. What are you going to do with debt? Now I'm going to start sharing the screen because I want to share some basic figures that we in finances know this, and that's why we share our knowledge with our clients, because there's a lot that we can help you. And this is not going to be one of those books where, you buy a book about losing weight and the first 12 chapters all about how you gain weight, and then the last chapter is all about how to lose weight. Or it's not about, like, your marriage is going down the drain, so the first 12 chapters all about why marriages go down the drain, and the last one, we're not doing that. We're just going to go right to the topic. But I do want to share with you that the statistics of debt in America, so you know that you're not alone in this. There's a lot of people that go through figuring out how to manage debt, and why is it that they got there. And debt is more than just the physical part of it, only owing the money or no, and paying those fees. Is psychological, is emotional. There's a relationship that we have with debt. And it's important for us to understand money, how we relate to it, so you can best live through that cycle and then eliminate the things that are going to put you back in that situation. So if you are on Rumble, and if you are on Zoom, you are seeing my screen, I hope. And so we went to debt.org, which is a website that can get you a lot of information on credit card, on personal loans, student loans, bankruptcies, mortgages, all kinds of things that you can learn from that website. It's a free website, and it's just a way to help society in general to get educated. Debt.org. So when I want to get some statistics from anything about borrowing and the feds, and especially when I'm dealing with mortgages with my real estate clients, I go here because I want to get what's the latest. So this was updated now in the summer, and talking about the demographics of debt. So 30% of American households are way above what they can make. So it's going to be impossible for them to pay their debt if they continue on their path. If you want to look at the average American debt by age, the 18 to 29-year-olds have about 13,000 in debt. The 30 to 40-year-olds have about $26,500 in debt. The 40 to the 50-year-olds have $28,000 in debt. The 50 to 60-year-olds have $24,000 in debt. And so 70-year-olds and older have debt. This is an average. So if you, out of the people that you know, the people that you run along with, the people that you work with, people that go to school with, the vast majority of Americans have debt. And how do we handle it? We need to learn from others. We need to see solutions. If you are in debt, most likely the brain that created the problem is not going to solve the problem. So you're going to try to figure out a solution. And I was speaking to our business owner this week, and she was talking about she became she's not retired, has some debt, and she became a early childhood teacher just to make some extra cash in her retirement. And we were talking about her brother who's in construction, and he's looking for somebody to help him manage his office because he's good at construction, but he doesn't know how to figure out the money part. And so it's important for you to have a handle of the money part of whatever you do. If you work for somebody, you do that very well. If you own your own business, you do that very well. Who's doing the money part of your life? And if you don't have a handle on that, or if you would rather ignore that, then this is the time for you to send me a message or send the agent that sent you this video a message and have somebody help you through that process. Learn it, know the basics, be aware what's going on in your financial life, but let the professional deal with that so you can be very good at what you do. Okay, so vast majority of Americans have debt, and the debt to income ratio is 30% or higher, which means a lot of people are owing 30% more than what they make in debt, which means they're never going to get out of it. It's going to be very, very hard for them to get out of it because 30% of your income, $3 for every $10 that you make go to debt. So it's very hard for you to get out of that cycle if you don't have a way to do that. Also so once this is on YouTube, I'm going to put in a link there for a debt consolidation calculator. This is one of the ways that you can figure that out. We're going to go over this at the end part of the video, but this is a very important tool that's going to help you kind of figure out what's the best scenario for you to kind of figure out how to get out of that cycle. Okay, so, and then we're going to be, and I'm going to be sharing the story of the Superman and Wonder Woman who have some debts. We've shared that with agents before, and Superman and Wonder Woman have their household, have their bills, and we're going to talk to you about how they got into debt and how to best figure that out. So before we go over all the data, I wanted to kind of just go over what generates debt, what puts a person into debt. And there's four major things that we see when we study about people that get into debt. How do they get there? Why is it that they are in debt? And the number one reason is that they don't have an emergency plan of action. So most of the time we're living paycheck to paycheck. We have a little bit of savings, but we have nothing to take care of emergency. And so when something big happens, we then have to borrow or we have to put on credit, and we're not prepared for that emergency. So if you are in that situation, you're watching this video and you say, you know what, I'm one of those. I'm not in debt. I can manage what I have right now, but I don't have a savings that is for emergency. If something big were to happen, I don't know how I would pay for it. So that's something that you need to consider. The second reason why most people go into debt is that because they don't have a budget. They don't have a system. They don't have a budget. They make money. The money goes from their employment to their bank account. They pay their bills, but there's not really a system. If I were to ask you how much money you make, you're kind of like, the money that that comes in, I don't know how much money I make. There's no savings. There's no investment plan. There's no system. You just make the money, you pay your bills, and whatever left over, you buy pizza. That's how you live. There's no system and there's no budget. So the third reason why people go into that is because they just have no maturity. They haven't matured as a consumer yet. They don't know how to say no to impulse purchases or emotional purchases. If they have the money in the bank, they have no system, and they're just not mature enough to say, is this something that I should do? Should I consider this? Should I wait 24 to 48 hours to make a decision regarding this purchase? No, they have no maturity. They're just go and buy it because they want to be happy. I work. I should be able to reward myself. That's the mentality of a person that has no system, no budget, and no maturity. I'm just gonna buy it because I deserve it without planning that purchase. And the fourth reason is a true crisis. A true crisis. Let's say that you do have some emergency, let's say that you do have some credit, but a major thing happens to you, a catastrophe in your home, your whole house just, a tree falls on your house and catches your car on fire, and your dog dies and everything floods. I mean, a true crisis where everything just falls apart. And even your emergency funds and your credit will not take care of it. And then that can happen, very rarely, but it does happen. And so those are the main reasons why a person goes into that. They don't have any savings, they don't have any emergency funds, they just don't have a system. They are not mature enough to make decisions regarding their expenses or their emotional or their their purchases. And then a true crisis will happen and people go into debt like that. So what do you do about something like that? So when you are in debt and when you face yourself with the situation that I'm 30% of my income is going to debt, for me to be able to pay that off, 30% of what I make or more is going to go towards paying that, which I either purchased without making a plan, or I fell into the situation because of, something happening with our family or with me. So it's important to put out there that whether you like debt or not, you want to pay it. The reason why you want to get rid of debt is because in the American society, it's necessary for you to have good credit. It's necessary for you to not have debt. If you are a young person, a teenager, or a young adult, I want you to look at the screen right now because I want you to listen to what I'm going to say. Today in American society, the financial world runs in one specific way. I believe that it does not have to run the way it runs right now. But at the age that my generation is, and the age of the 40-year-olds, I don't believe that we are able to change how the financial world runs. But I do believe that the 18-year-olds, the 20-year-olds have the mindset to completely disrupt the financial world and come up with something that's better than what we have right now. And so just like Airbnb disrupted the hotel industry, Netflix disrupted the movie industry, Uber disrupted the taxi industry, I believe that there is a way to disrupt the financial industry. And you are out there. I know that the person that is going to come up with that idea is out there. And the more we talk about it, the more we encourage the next generation to do so, I think that they will rise and they will fix this issue. But credit scoring, a credit profile in the United States exists. And that's how we do business in here. It doesn't exist in other countries. Not every country has a credit scoring system where you are bound to it. I'm just going to share how I believe with you. The three major credit companies, credit scoring companies, are not federally owned. They're not an institution of the government. They're privately owned. They make money doing what they do. And if you have any kind of those systems, Credit Karma, Credit Sesame, Credit Wise, any of those systems that you can check your credit, they're constantly sending you offers. They're making money. And the same people that make money on your clicks on their emails or their websites or their app is the same company that grades your credit. That's all you need to know to understand that really is not a neutral parameter for the financial world, right? Like find out who owns these companies, who owns TransUnion, Experian, and Equifax, and then you'll realize that this is just a big I don't want to say the word mafia, but that's what I believe. It's just a big mafia because they're the ones that give you the credit. They're the ones that benefit from you clicking on their links to better your credit. So why would they score you a better way when it makes money for them for you to have debt? Think about that for just a minute. So young people, you have a better way. I know that. But fixing credit is something that we need to do in order for us to live a better life and for us to live a life where we're not paying institutions our fees. If you don't have good credit to get a car loan, to get a home loan, or you're going to pay more money for those big things. But it's not only on those big things. Let's say they are not interested in buying a car or interested in buying a house. Let's say that you're just getting a cell phone or car insurance or cable. Do you know that they pull your credit for those small purchases, which means you're paying more money for simple services just because of your credit. So it's important for you to take care of your credit. And having debt does not help you on the long run. That's why you want to make sure that you fix your credit. And you have better choices. When you have good credit, you have better choices. When you run your credit for cell phone companies or for car insurance companies or for your cable company, you have better options, better plans offered to you because your credit is best. So it's important for you again to take care of those bills that you are paying interest rates on to banks and making them rich instead of making you rich, right? Now, let's talk about regular expenses compared to finance charges and fees that we pay to other people. I want you to think a little bit about all the bills that you pay every month, all the things that you have on your budget. Okay, there's some bills in that list that are the same every month, your mortgage, your car, the regular flat fees that you pay every month. And there's some bills that fluctuate, right? Some bills that change because of usage, because of how many days of the month there are, whatever. But most of the bills that you have are very, you can kind of figure out that you're going to be spending that kind of money on a monthly basis. Inside those bills, if you were to kind of peel off all of the layers of those bills, you will notice that there are fees attached to the bill that are added on to the bill because you are breaking down a monthly, a quarterly, a semi-annually, or annually payment plan. We've discussed this before with regards to, for example, car insurance. Car insurance offers you a full year payment. So you pay a one-time lump sum or you break it down. If you were to pay one time, it's cheaper than if you break it down. They add more money onto each monthly payment because you're breaking it down. That type of a fee is money that you do not recoup that money. It's just a fee that you pay just because you chose to break down your annual premium. So that means that fee gave you nothing else except for the fact that you were able to break down in small bits. If you had credit, if you had savings, you could pay that one-time lump sum and then make that a savings. That fee does not need to be given to that company. That fee could be saved and it could be snowballed into other fees that you are paying other companies to benefit you financially. So those are smart, wise decisions that you're going to start watching on your statements and on your billing cycles in order for you to avoid paying those fees. Finance charges and regular fees eat up, like we said in the beginning of the video, 30% of our income. I want you to kind of think about that for just a minute. For every $10 that you earn, $3 go to finance charges. That goes right back to the bank. It's not even to the taxes or anything. 30% of your income goes to fees and charges. If you own a home, a large percent, until you're in the 18 years of your mortgage, more than 50% is for your finance charges on that property. I know we're talking about the biggest one, but when you think about 18 years of a mortgage is when you start that's when you start paying 50% into the principal and 50 into the interest. Not until then. 18 years of a 30-year mortgage is when you start paying half and half. which means for the first 18 years of a mortgage, you're paying more interest. That's why a vast majority of the families are paying 30% of their income into fees, because we borrow. Okay, so how do we figure this out? How do we go about looking at our bills, looking at our statements, and figuring out how can we make this better? There are several companies out there that offer something that's called debt elimination. So they are a company that will help you with all of your bills. They'll help you call the creditors. They'll write letters to the credit scoring agencies to help boost your credit score. They will do that service for you. They'll charge you a fee for that. You could do that by yourself as a consumer. It's a free thing for you to do. But if somebody's going to take their time and use their skills and their staff to do so, of course, they're going to charge you a fee to do that, which is another fee that you're paying out. But sometimes we just don't have the time. We have children, we have homes, we have our jobs, and we just don't have time to sit down and take care of our credit. Therefore, it's easier to pay somebody who's skilled in that field and let them do that. And then there's another way to do that, which is consolidating that debt, which is another way to say, instead of paying 20% one credit card, 27% another credit card, 30% another credit card, we're going to consolidate all of that, and we're going to pay one loan 15%. So it's going to lower every one of those APRs that you're paying in fees. You're still going to be paying fees, but you're going to lower the amount, which then is going to have some money left over that can be applied to snowball the payment of one of those debts. And then once you pay, you never lower your payment. You continue to pay as much as you can, but the payment is going to be lower because the APR that you're paying towards the bill is going to be lower. So then you're going to attack more of the principal. If not any of these words seem like, I don't know what you're talking about, message me and we can go over your financial map. Okay, because everything that I'm sharing today is a blanket statement until we look at exactly what you're paying, what your bills are, what your APR that is being paid to the bank. You can't have a true picture of your financial map. So if you want a financial map that's made for you for free, message me, put a comment on over here, and I'll contact you and we sit down. I have a 1-hour consultation that is free of charge. I'll show it to you on your screen so you can see what it looks like, your financial map. And it's free of charge because you need to know what you need to do with your money. So I want to talk to you a little bit about those two options. Either you taking the time or you hiring a company that will look at your credit reports, look at your credit reports and see what is there, what is negative, what is on collections, what is late, and then deal with each individual creditor and either asking them to remove those marks from your credit report, finding a way to pay them back, asking them to lower your APR that's being paid for you to be able to attack the principal faster and eliminate that debt. So those are the conversations that you have to have with each creditor, or having a company do that on your behalf, which is then is going to be another cost to you. But they are very efficient in that because that's what they do, right? You do you, they do that. So I think that that's a great way for you to do that. If you do not know this, I want you to get a piece of paper and a pen, and I want you to give you a website where you can get your free credit report so you can see what it is on your credit report. There are 3 major credit reporting agencies. It's Equifax, Experian, and TransUnion. Equifax, Experian, and TransUnion. And you can get those 3 reports from the one free website. So if you ever go to those apps that say get your credit, no, don't pay for any of the stuff. Get it all for free because it's yours. You can get the stuff for free. So it's annualcreditreport.com. Annualcreditreport.com. If you go to that website, you can download your 3 credit scoring agencies reports for free. Before COVID, it was once a year. Now that COVID happened, they allowed it to be once a week, and it's still once a week. You can still go and upload your credit report once a week, and it's free. And what happens is it's not very difficult to read these reports, but you go to the first one, you answer a few of security questions to make sure that you're you, And then they'll let you see the report. You open it up, you print it, save it on your computer, and then you say, go to the next. Once you go to the next, you can't come back to it. So make sure you save it and print it. The next one, do the same thing. Answer a few of your security questions to make sure that you're you. Open the second one, print it, and then do the third one. And then when you're done with that, close that, log off and close that. The other thing that I would suggest is that you go to the 3 different agencies and open and sign up to have an account, a login and a password, so you can see your credit. Because if you are on reading those reports and you see something that is incorrect over there or that you want to dispute, then you're gonna go to each individual one and do disputes individually with each one of these. If you don't know how to do this and you want more tips on that, on my YouTube channel under financial education, I have videos regarding how to go through that process. And there's a ton of videos on this on YouTube. So you get to kind of look around and see which one you like best. But you do want to have a system of how to do that. So disputing online, some of them are disputes that you can just have them refresh to show your payment. Some of them you need to dispute that they're not marking your regular payments. They're showing that you have a late payment, which does weigh a lot on your credit. So you want to dispute those. If you have the receipt of that, if you have the statement that shows that you make a payment and they're saying that you didn't, you can dispute those things. You can show the statement sent to them. You can call them and talk to them. There's many different ways to dispute wrong things on your credit report. But if you actually did not pay your bills and if you have negative marks on your credit score, there are different laws that recently passed that allow you to request for those marks to be removed. Again, if you don't know about this, please write over here and I'll get you more information about that. But if you indeed defaulted on your payments and then you have some questions about if those things can be erased from your credit report, mark down here, send me a message, and we will discuss this individually, because we need to see what it is that was marked over there. What is the reason? Because there are many ways that you can erase these negative remarks on your credit score and credit reports to then make your credit score better, right? And that gives you better options for purchasing and better options for borrowing in the future. Now let's talk a little bit about, so that's one way to do it. Let's talk about credit consolidation. The reason why I want to talk about credit consolidation is it's a little bit easier to deal with what you want to do, which is to better your credit, to pay off your debt, and to move on with your life. Especially because let's say that you do have all the stuff that is in your credit report is truthful. You did default on your loans, you did not pay your bills, you were late on them. If that stuff that cannot be disputed and is truthful, then your next best bet would be debt consolidation. And what you want to do is you want to talk to the lender. You want to get a professional and sit down with a professional and talk to the lender and explain your situation and ask what they can do to help you get ahead on your debt. Many times a phone call to the credit card company or your car loan or your student loans are no. Student loans, there's no help with that. You may refinance your loans for a student loan, but regularly student loan, there's no hope for that. You have to actually refinance your loan with a lower rate. If you're like student loans are 3%, 5%, so they're fairly good rates for you to just go ahead and keep paying for them. But if they're higher than that, then you can refinance them for lower rates. They will refinance for lower. But you're consolidating your debt is one of the best strategies if everything that's in your credit score and credit reports are true, which means you did default, you did miss those payments. So what you're going to do is you're going to open up your bills, open up all the things that you owe, and you're going to write them down. And what we want, so if you are on Zoom, I'm going to share my screen one more time because I want to show you what we're looking for when you're making that list. So I have a couple, Superman and Wonder Woman, and they are in debt. So they have, if you are on Zoom right now, if you're not on Zoom and you want to see the screen, it's a bit if you are on Rumble and Instagram, I put the link for the Zoom under the post for today's live, but it's bit.ly/Anna Zoom link. So they have two credit cards. One is at 28%, the other one is at 30%, and they owe 2,000 and 5,000. Then they have a car that is $35,000, and they have another car that's $27,000, and they have two homes, the primary home and a rental home, one for 200,000 and the other one for 150,000. They have pretty low rates on that. So this is what you want to do. You want to sit down and you want to write down the charge that you have, what is the interest rate that you pay, what is the principal that you pay, what is the interest rate, I mean, interest charge that you pay, not the AP, not the percent, but the actual dollar amount that is being paid out monthly for all those interest rates, right? So what is the interest rate that you pay monthly? For example, let's say that your home is, we're not going to put homes on this. Okay, let's put credit card, 27%, and you owe 1,000, then you're paying $200 in your regular payment. Out of the $200, how much goes to principal and how much goes to interest? That's what we're looking for. How much goes to interest of out of every payment that you make towards those bills? And what I want you to do to kind of open up your mind and open up your eyes to what happens to your money on a monthly basis is add up all of the dollars that go towards interest rates, interest charges. Everything that you're paying on a monthly basis that goes straight to interest. Because there's an awakening when you go through that exercise. There's an awakening when you see how much of the dollars that you are working, you're exchanging your time for dollars. Every day you go to work, you exchange your time for dollars. And then when it comes time to pay the bills, you exchange those dollars that mean time to fees towards banks. So what happens is your precious time that can be invested with your children, with your family, is now invested into paying finance charges and fees. And that is going to motivate you to fix that, to not have that happen to you month after month after month. And so then when you have that list and you have that amount, you're going to have a strategy, you're going to have a map, a plan of action. If your interest charges are 5% or less, you're pretty good. It's okay in this economy, in this environment, to pay something that's 5% or less in finance charges and in fees, because the inflation is higher than that. And you could probably make a better deal investing that money somewhere else. Not every debt is a bad debt. It's only the debt that is bigger, if the finance charges that you're paying are bigger than what you could be investing on. So if you don't have a cash flow in between the investment part of your portfolio and the APR that you pay in finance charges, if it's negative, then you need to get out of that debt. But if it's positive, it's okay to stay in that debt, because the remainder of that money is being invested somewhere else. It's being used somewhere else that's more profitable to you. So again, if that was a little too confusing, I wanted to send me a message, because we can go over your specific situation. If you're saying, I do have a house, for example, we have a property that we paid, we bought it at 2.9% on the bubble, right? We're not touching that loan. We're not paying off that loan earlier, because my money's used better elsewhere. A 2.9% mortgage is not interesting for me to pay off earlier, where I can use that money to grow at 15, 20% right now somewhere else. Why would I take my money that's growing at 20% to pay a 2.9% loan? It makes no sense. So it's not financially wise to do so. But if it was the opposite, if my bill was 20% and I was getting investment at 3.3%, it makes no sense for me to do that. I have to use to be able to pay off that APR that is so high and it's eating up my income. Okay, so you need to make sure that you're wise about where is the money going, what is the strategy that you're using to eliminate debt the fastest way possible, and eliminate the debt not only just fast way, but eliminate the vast majority of the APR that's going towards the bank. Can you recoup that money that is going to the bank? Because my time is being exchanged for those dollars have to come back to me. They don't have to go to the bank. If I'm getting a benefit for that exchange, great. If I'm not getting a benefit, I'm going to fix that. So I'm getting the benefit for the time that I exchange for those dollars. Okay. So consolidating. There are very important things when you think about consolidating that you want to consider before you choose a consolidation company. And I'm going to plug my own debt consolidation company. I own a debt consolidation company, has been in the market for about 10 years, and we help families get out of debt. And we don't charge initiation fees, origination fees, and we make sure that if you have a debt that you want to pay off, and the finance charge that we pay is larger than one of your debts, we encourage you to stay with that lower debt, because it makes no sense for you to lump it on a new consolidation loan and pay more. It makes no sense. Our job with Excellence Financials is to make sure that you, as a consumer, you are strong, you're thriving, financially, you're thriving, your family's thriving, because what we want to see is families thrive. When an individual thrives, then his family thrives. When his family thrives, then the community thrives. And the community thrives, and all of us thrive. And so it's important for us to understand how the money part of your life is going to totally affect your emotions, your behavior, and your performance. And that's going to turn around your family, your community, and the world around you. So it's our desire to help families get better at that one specific thing. So just a plug that we do have a debt consolidation company. It's called Excellence Financials. And we've been in business for a minute, and we help families figure out how to get out of debt. And our job is to walk through that process, not only eliminating that debt, but also teaching you new skills. So when you're looking for a consolidation company, what you don't want to do is you don't want to have to pay an origination fee. You don't want to lump your smaller debt into the higher percent that they're going to charge. So if you have several different types of debts, pay attention to the APR that you're paying, because it sometimes makes no sense for you to add a 5% APR onto a 15 or 20% APR that the debt consolidation company is going to charge you. So pay attention to that as you're lumping all of those. And then find a company that's going to allow you to make several payments a month instead of one lump sum. Because what happens is most of the time we work and we have little monies coming in. If you have a gig, if you have another job that's going to supplement that, if you have two income families, and those two payments are going to come in at different times of the month, you don't want to wait until you lump sum all that payment in one time. If you have little monies coming in, make sure that your debt consolidation company allows you to make partial payments, because it's going to help you pay that off early. The earlier you pay a debt, the less APR you pay. Vast majority of those the companies that let you borrow money, they charge you a daily interest rate. So if you can pay early without a penalty, it's beneficial to you, because you're going to allow that principal to be paid off faster and have less interest rate to be paid at the end of the month. So make sure that that's something that the debt consolidation company is going to allow you to do, to pay early without any penalty, and it's going to help you pay that off faster. Once you have chosen that debt consolidation company, make sure that it's in writing and they are indeed a credible company that's going to be paying off. What we do at Excellence Financial is we create a loan. We've define collateral, and then we go ahead and we pay off your debts but before we do that, we go ahead and connect with the lender to lower your APR, but keep your accounts open so your credit stays intact. Initially, you're going to see all of your debts paid. Your credit score is going to raise. We're going to help you apply for new credit that you're not going to use. We're going to teach you how to do these things so you'll get smarter and wiser about money. So that once your credit score raises and you have better options for credit, we're going to teach you how to apply for new credit. Do not use that credit. So then you have a larger total amount of credit available to you. That's going to help you have an emergency fund. That's going to help you have a way to pay off emergency or emotional purchases in the future once you fix your credit. Then we're going to teach you how to pay off that loan super fast by using the infinite banking concept. And once you're done with that, you're going to not only have the extra amount every month to you, but then we're going to teach you how to invest that money so you can leverage that amount of money that was going to the banks now towards the future of your family. So that's the job of our company. Excellence Financials does that for you. So we go through all those steps together with you. But debt consolidation does just that. It lowers the APR that you're paying. So there's more money left over that goes towards the principal to eliminate that debt faster. And then you can snowball to the next debt and then to the next debt. So if you're looking at, if you aren't with me on Zoom, you're going to notice that, let me show you 2 ways to do it. So if you are familiar with what we call the infinite banking concept or the family bank concept, this is the picture of Superman and Wonder Woman with those debts that we have spoken about, and they're putting $500 a month towards eliminating those debts. So it's credit card number 1, credit card number 2, car number 1, car number 2, property number 1, property number 2. So their current balance in all their debt is $403,000. If they are staying on the same path, they will be paying $594,000. So it's $194,000 in extra finance charges that they're paying. Okay. Now, if you watch this, if they do this program and then they sit with us and we teach them how to do that, they can eliminate that debt not in 27 years, but in 13 years. And they're going to have a liquidity of over $800,000 because now the money they're paying in fees is going towards putting into investment in assets. Okay, so it changes it because the money that was going to the banks is not going to go to you, and now it can be invested in a guaranteed way where you're not losing it, but you're always gaining compound interest on that. Now, the same exact figures, but instead of just finding money to put on towards paying off those bills, let's say that they dump all of their income into a plan. So let's say they put $5,000, $5,500. So instead of the 500, they put another 5,000 towards that. And I want, if you're looking at the screen right now, you're going to see the biggest difference, because when you do that, and there's a lady on YouTube that teaches that. So instead of using just what's left over to pay your bills, you use your credit to dump all of your salary inside the credit card. So pay your credit card, your full salary, and then you use your credit card to pay your bills, because it's going to give you 30 days to reassess and reallocate those funds in order for you to eliminate those fees that you're paying and have more time to pay your bills and start diminishing those monthly payments. So that's the idea, really, what you have over here. But instead of using a credit card, you're using a family bank. That's a tool that we offer for you to figure this out. So instead of the 500, looking at 5,000, all of a sudden you're going to pay that off in 5 years instead of 13 years. So you accelerate the payment by 5 years, 6 years, and you're going to end up with not $800,000 in liquidity, with 5 million in liquidity. The reason is a choice, a concerted choice for you to kill the debt bug once and for all by using all of your funds. They go in there and they are liquid, so you can recycle your money. Instead of just finding dollars to pay your bills, you're going to use all of your effort. It's like when you have when you have you're going to eliminate a vice of yours. Instead of doing little things at a time, you just do cold turkey, just get it done all at one time. So it's scary in the beginning because you really don't know how it works, but it truly works. And there's thousands of people that have used this program and they have really had great success. But so if you want to see how this works and you're curious to find out more, you can message me here. the reason why I share this is because there's a lot of people that know they got to do something. They look at their bills every day and they're like, oh my goodness, I have to do something, but they don't know where to start. And they don't know that they have a person that they can count on and they can trust. Most of the time when you're talking about money, it's hard for you to share your bank account, what you owe, your bills with somebody that you don't trust. Sometimes actually it's better, right? Because that you don't know that person because it's not emotional. But most of the time when you don't trust that person, it's very, very hard to share that much information. In fact, the very first time that I had somebody approach me to say, hey, do you want to do your financial map? I said, I don't know you. Why would I sit with you and show you my bills? That was something that to me, I felt weird about talking to her about. But now that I am on the other side of that coin and I see the benefit of having a professional help you, just like your tax advisor, you share your tax returns with your tax advisor. You share your income, your expenses, your social security number, your address, all that stuff with your tax advisor. They don't make any judgment on you. They're just there to provide you a service. The same thing as your financial advisor. They're there to provide a service. If you feel like you are capable and you have the knowledge and you study every day and you can do either a debt elimination program where you're going to contact the providers and lower your APR and create a plan of action and then start disputing the things on your credit, or do a debt consolidation where you have a family member that's willing to loan you money for nothing, or pull from friends and do whatever you can do. That's a great way to do it. But if you don't have that person and you prefer to trust a professional, there's a ton of them out there, ton very reliable people that can help you do that. And so based on that information from debt.org, I would strongly suggest you that if you came on the phone call today and this is you, take the first step. I'm going to let that sink in for just a little bit. Because when we have debt, it's just so overwhelming. We know we have to do something. We know there's somebody needs to come from the sky and help us out, but it's just so uncomfortable and procrastination takes over. It's so painful that we just don't want to do it. So we end up not doing it. And again, you're exchanging your time for dollars, that those dollars are going to the bank. Those dollars are going to the creditors. Those dollars are going to finance charges. And is it worth it to you to take the first step? And truly the first step, if you clicked on this video, you're watching this video and you're paying attention to this information, the first thing that you want to do is you want to take the first step. Do not let yourself let it go anymore. Don't allow yourself to say, I'll do this tomorrow. I'll start looking at this path. I'll do some research. And what happens is you let another day pass by and another day pass by, and all those finance charges are charged to you daily. Credit cards charge you finance charges daily. Mortgages charge you finance charges daily. Car loans charge you finance charges daily. And so every student loans charge you finance charges daily. If you do not take the first step, they will continue to charge you. And in fact, they're rooting that you don't take your first step because they continue to make money and taking the money that you have earned to invest in your family and in your future for them. So this is my call to action. This is an encouragement to you to do so. In my 20-something years in the sales career, I helped women get out of debt. I used a tool in personal sales. And that was my way to help women figure out that there is another option. And in that field, I had to encourage them to go and sell something, because with that sale, the money would come into their family and their family would then take advantage of that. And then I would sit down with them at the end of the month and show them how to apply that money wisely in their budget to be able to then get to their dreams. They had dreams and they had wants for themselves and their families, and they used the tool of their sales. Whatever it is that you do, You may sell, you may work for a corporation, you may have a salary, you may have an extra gig, you may have a spouse that earns money too, you may have passive income, whatever it is, use the tools that you have, get with the professional, and take your first step. Because if you keep doing what you're doing without changing your behavior and without having a plan of action, you're going to get same exact results over and over again. Thank you for watching, you guys. I want you to leave me a message and I'll get back in touch with you. I do a Portuguese class right after this one. So in about 5 more minutes, we're gonna go back on live and do the same class in Portuguese. And I know that if you have friends that speak another language, Spanish or Portuguese, they're welcome to come and watch it too. And so here's my disclaimer, okay? I am not a fan of Facebook. I'm not a fan of Instagram, and I'm not a fan of WhatsApp. My broker has encouraged me to get these videos here. I've been using YouTube and Rumble for the longest time, and Telegram. Those are my favorites. But he says the message that you have is so important that people need to hear. I want to migrate completely to other forms of social media. I don't believe in the owners of these three. I don't believe in the owners and the people that run Meta. I don't believe their standards. I don't believe what they believe is important. I don't want them using our data and our money to run what they believe is important. I believe our money is best invested somewhere else. But I will use this platform until I know that everybody can hear me at other platforms. Okay. So I'm going to keep on here until we build the other platforms to a size that I believe is healthy for us to continue there and not here. So I am going to be sharing these videos here, but I don't like it here. And I hope that I encourage you. So if you don't like it here, get out of here. Find another way to get your name out there to grow your tribe, to grow your business somewhere else. Meta company does not deserve what we have to offer. They are not doing good with our money, with our data. They're not wise with what they do. So let's show them that we are better somewhere else. Okay. So that's my disclaimer for today. I hope to see you next Tuesday, every Tuesday at the same time, different topics every week. I love you guys. Thank you for being here.